On this issue, we're going to be looking at the topic of overtrading, which are some of the problems associated with growing too quickly. As the name implies, overtrading is when you expand too quickly without the financial backup to support it. One of the things that you really need to get firmly in your head is that cash and profit are two completely different things. A firm is usually profitable when it overtrades, but it's run out of cash, and a firm will be just as dead if it runs out of cash as if it runs out of profit. And the reason for overtrading is that frequently there's a time lag between paying out the cash when you are producing goods for sale, because normally you have to produce those goods before sale, and receiving the money for those goods that often occurs after sale. So for example, Tesco won't pay you a penny for 3 months after you've sold goods to them. In my example that I'm going to set up, I'm going to be building in a 1 month time lag. So I'm going to set up a pretty straightforward scenario. We're going to assume that our firm sells £1 million worth of goods every month. It receives the money 1 month after sale, but it has to produce the goods 1 month before sale. I'm going to assume that the production costs are 80% of revenue, so there's a 20% gross profit margin, and our overheads are £100,000 per month. Let's have a look at this firm's income statement. It's actually pretty good. If it's selling £1 million worth of goods a month, then it's going to be selling £12 million of goods every year, represented here as 12,000. If its production costs are 80% of revenue, then its cost of goods sold are going to be 80% of 12 million, which is 9.6 million. The overheads are building up at 100,000 a month, so over the year that's going to be 1.2 million. So our revenue is 12 million. Our costs are 9.6 mil cost of goods sold plus 1.2 million overheads. That's 10.8 million. 12 million minus 10.8 million gives us a nice little profit of 1.2 million pounds. The cash flow statement is pretty good as well. We are selling £1 million worth of goods a month. The money is actually being received the month after sale. So if you look there, the cash in for January represents the orders that were received the previous month in December. Remember that we have to produce a month before sale, so we've got the goods on hand. So if we look, for example, at the March production figures, they are 80% of the April expected sales. So that £800,000 is 80% of the £1 million worth of sales that we're planning to do in April. So in most months we've got £1 million coming in, 800,000 production costs plus 100,000 pounds worth of overheads means that there's 900,000 going out. So we have a net cash income of 100,000 every month. Now in November, we're actually going to pay a dividend to our shareholders of 800,000. Remember that we're making 1.2 million profit, so we're ploughing 400,000 back into the company, but that 800,000 leaves the company in November. Despite that, you can see that by the end of December, we've got a balance of £600,000. That's the figure on the bottom right, whereas we started on the top left on the cash flows with 200,000. So the cash has been building nicely in the company. It's gone up by £400,000. In the next year, we are going to hit takeoff. Maybe the product has been promoted or mentioned by a celebrity, and our sales are going to rise by £250,000 every month. So you can see that in January we'll be selling 1,250, then 1,500, 1.5 million pounds worth of goods in February, all the way up to 4 million in December. And we're going to take a look at how that affects both the income statement and the cash flow. Well, the income statement is absolutely fantastic. Remember, in the previous year we were selling £12 million worth of goods. Now that has gone up by more than 2.5 times, up to £31.5 million. The cost of goods sold, well, that's going to rise, of course. It's going to be 80% of the revenues. So our cost of goods sold is now 25.2 million. Our total costs are 26.4 million. And we're going to be making a profit of 5.1 million. Now remember, in the previous year we made 1.2 million, so our profits have more than quadrupled. We are going to be delighted from an income statement perspective at that. However, let's look at our cash flows. Remember, we came into January with 600,000 in cash. We are going to be receiving, in terms of cash in, 1 million from our sales the previous month in December. But we're producing for the expected sales in February. Remember, that's going to be 1.5 million. So our production costs in January are going to be 1.2 million. So with our overheads at 100,000, our cash out is 1.3 million, but our cash in is only 1 million. Remember, we're receiving the money after sale, but we are producing the goods in preparation for the sale in the next month. So our net cash flows are going to be 1 million minus 1.3 million. They're actually going to fall by £300,000. Not too bad, because remember we had 600,000 going into the month, so we've still got 300,000 left, but it's now starting to go down. Now let's move into February. Well, our cash in is going up a bit because those sales from January, the money is now coming in February, so that's gone up to 1,250. But the cash out, we are now producing for sale in March, and 80% of 1,750 is 1,400. So with 1,400 in production costs and 100 in overheads, our total cash out is 1,500. Cash in 1,250, cash out 1,500. That is a net cash flow of minus 250. Remember, we went into that month with £300,000. It's gone down by £250,000. We've still got 50,000 left. It's still positive, but we're starting to sweat a bit. Moving to March. Well, again, our cash in has gone out because now we're receiving the money for the goods that we sold in February, but we're producing for the 2 million goods that we're preparing to sell in April. So we have another negative net cash flow of minus 200. Remember, we only had 50,000 going into this month, so we've now hit an overdraft. And the bank is starting to ask some questions. The bank is starting to see a deteriorating balance. They're going to be telling us to sort ourselves out. But in April, once again, the cash in has gone up, but so's the cash out. We've got a net cash flow of minus £150,000. So our cash position has actually got worse, and at this point the bank may well pull the plug. The company is dead. So what if we're able to persuade them to keep us alive for a couple more months? Well, they are going to be concerned. They would have seen a decline in our cash position from positive 600,000 to negative 300,000 in the space of a couple of months. They're going to be saying to us, sort yourself out. But if we extend this up to, say, June, the situation actually gets worse. And by June, we are £450,000 overdrawn, nearly £500,000. So if they didn't close us down in April, they would have closed us down by June. We are a dead company. Forget about those profits. We're dead. So am I telling a story that's slightly exaggerated? Sadly not, because I've assumed that our fixed costs are going to continue at 100,000 quid. Well, have we actually got the warehouse space for the inventory that we're producing for the next month? And if we have, then presumably our insurance costs are going to go up. And if we haven't, then we've got to find additional space, so we'll have to rent that. Might we actually need a complete new production facility? Remember, our production facility was used to producing £1 million worth of goods a month. Well, by the end of this year, we were planning to sell 4 million. So it may well be that we have to increase our capacity. What's going to happen to our variable costs? Well, they are likely to rise as well, because either we're going to need more staff, and those staff, of course, won't be as well trained as our existing staff, or we're going to run our existing staff on overtime. Maybe we're going to have to get a night shift, because remember that we are quadrupling our production over the course of that year. Similarly, on the admin side, again, the overhead side, we're going to find that our offices are starting to fill up. Our people are going to be trying to chase up more and more and more customers. So either we're going to have to get in more office staff, which could raise a problem of space and stress in the office, or we're going to allow some of those late payers to be even later payers, and slow payers sometimes become no payers. So if anything, I would expect our overhead costs to rise and also our production costs to rise. So the situation is actually worse than I've presented it on my simple model. So we've just done a classic 2 paragraphs. From a profit perspective, that increase in sales is fantastic, but it could kill the company off from a cash perspective. Remember, Peter Jones of Dragon's Den says cash is king. Profit's nice, but cash is king. So now we need that 3rd paragraph where we're going to say really what the firm could do about it. And the obvious thing that the firm can do is to keep the bank in the loop. So if we start to see our sales rising and we start to see our cash position declining, we call in the bank, so we preempt the model. We try to arrange an overdraft. Probably we'd have to do that around about February, because 1 month increased sales might not mean much. 2 months we start to see a bit of a trend. So in February, March time, we're having a word with the bank saying, look, this is what is happening. We're expecting our cash position to decline. Probably do a couple of predictive cash flows, one optimistic, one pessimistic, but they would all be suggesting that the cash position would get worse, and the bank might have expertise, and the bank might be able to offer us a higher overdraft or some sort of facility to tide us over. Now, the impact on cash is, of course, we haven't got any more cash. That's not what an overdraft request is, but they are allowing us to go overdrawn. We'll need to pay interest on the overdraft, of course, and that's going to hit profit. But remember that we're going to hit an overdraft anyway. And if you have an unauthorized overdraft, then the interest is higher than if you've actually managed to arrange it with the bank. So that isn't actually a deterioration of the situation. So that is what I would do first of all. Now, the second thing we can do is try to arrange trade credit. We are producing a month before production, but frequently when firms buy in materials, they don't actually pay for it at that time. There's advantages to paying for it early, because often you get early payment discount. But if we can arrange to pay our suppliers a month later, okay, our profit's going to be hit slightly because we'll be spending a little bit more, but we'll be delaying that payment. Remember, the problem is cash flow, not profit. So we'll take a minor knock on profit, but we'll be improving our cash flow. So we'll be trying to make our payments a little bit later. Now, is there anything we can do to get the payments in a little bit earlier? Well, yeah, we could offer our customers early payment discount. So if they pay in the month that they receive the good, basically paying cash on the nail, then we could offer them slightly lower prices. Or alternatively, what we could do is offload those debts. We could sell those debts to a specialist firm whose job is basically to chase up debt. So we could offload. Now, what they tend to do is they will pay you a sum for the debt. They're going to take some money for themselves, of course. So again, I'm assuming that they're going to be paying, say, taking, say, 5% of the payment. So you sell them £1 million worth of debt, they pay you 950,000 quid, and they keep the 50,000 for themselves. So let's look at the impact of that on cash. Well, first of all, you can see that by bringing in that debt collection firm, our income is slightly down. So our cash in, say for January, is 1188, but you'll notice that we are getting the money in the month of sale. The debt collection firm is paying us, so it's slightly less. They're going to get a bit of the money, but we're going to get in, say, 95% of the money. Similarly, the production costs. Now, again, we've managed to align our production costs with the time that we're actually getting the order. We're still producing a month ahead of sale, but we are delaying payment by 1 month, and we're paying a little bit more than that. So you can see there in February, we are paying out 1275. That's 85% of the order value rather than the 80% that we were paying before. But we've been able to drag that payment back by 1 month. Another little bonus there is you'll notice that we aren't paying out any production costs in January, because we had already taken that into account in the previous December. So there's 1 month where effectively we've got free production. So what's the impact of that? Well, if you look down that bottom line, remember that's the one where we were hitting the big negatives on the cash balances. You can see that we've got, once again, steadily rising cash balances. We started with 600,000 at the beginning of January. By October, we've got 3 million cash carried forward. We've actually got enough to pay a 1.6 million dividend. Remember, last year we only paid 800,000. This year 1.6 mil, and we still haven't run out of cash. We actually finished the year with more than £2 million in our balances. We started with 600,000 despite paying a 1.6 million dividend. So what's the position on profit? Well, you'll notice our revenues after these changes are lower than they were before the changes, because we are paying out that debt collection firm 5% of our revenues, but they're still up by 150%. And our cost of goods sold are also higher because, again, we've lost that early payment discount. So our revenues are now just under 30 million. Our costs are around about 26.5 million, and we finish up with 3.2 million profit. A lot less than the 5.1, but the company is still alive. And you'll notice it's a lot more than what we had the previous year. So our profit is still up by 150% on the previous year. The firm's alive. We've sorted the problem. We can give ourselves a pat on the back for a fantastic third paragraph, and that's where I'm going to end it.